Good morning, everybody. So my name is Andrew Auslander. Thank you for attending. We're going to be talking about risk management metrics. We're going to be talking about accounting rule changes. What could be more exciting? And I promise I won't be doing any Bollywood dance moves, so you're safe there. Okay, so I'm going to go over these topics. Okay. I'm going to go over just a couple of the major challenges that face risk management. I'm going to go over that risk management is shifting from a compliance focus to more of a performance focus. That KRIs need to be tailored to business strategy and risk appetite. After the business strategy is done and the stress testing is completed, specific KRIs are needed to monitor progress. These should cover concentration, geography, industry, etc. Integrating KRIs, KPIs, and KCIs. Data analytics and data mining to derive value from your data. And the major part of the presentation is going to be the current expected credit loss, also known as CECL. I think this is a great example of using risk metrics and forecasting out. You have to go out to the maturity of your credit instrument. So if your credit instrument is 30 or 50 years, you have to go out 30 or 50 years. And then I'm also going to give an example of liquidity risk management. Okay, so let's get started. So here's, obviously this isn't all of risk management's challenges, but this is a few. Risk management function is asked to deliver information in almost real time with the following challenges: legacy applications, access to the correct data, no centralization sometimes, and trying to consolidate dispersed data sets. It's a complex, time-consuming process to finalize results. As the last speaker just talked about, if you're using Excel, it could take you weeks sometimes to put together presentations, to prepare the dashboards that upper management needs. And then regulatory reports, you need to put those together. Those also are usually very time-consuming. So, as the last presentation was going over with using MetricStream, using Tableau and other tools, you can put together risk dashboards to monitor all of your risk triggers and limits in order to have KRIs, KPIs, and your KCIs, your key control indicators. But in order for this to work, the firm, of course, needs good systems and good data. Okay, so now I'm going to go over what I mean by shifting from compliance focus to performance focus. The idea is to reuse all the Dodd-Frank CCAR infrastructure that was set up in the past few years. I think all risk management departments agree that stress testing is important, but it has to be more tailored to the business strategy of the firm. The idea is to use your existing infrastructure, systems, data, people, and extract better information that provides more guidance for the specific business. And, performance really comes from actionable information that allows the business to make better decisions that impact their profitability. The other thing I should have mentioned at the beginning is that if you have a question, feel free to raise your hand while I'm speaking. I'd like it to try to be somewhat interactive. Okay. So KRIs should be tailored to the business strategy and risk appetite. KRIs should measure changes in levels of risk and act as early warning indicators to prevent crises and allow time for mitigation. The attributes of these KRIs, since everybody's business is different, but here are some just general attributes of them. Quantitative, meaningful, predictive, derived from the data produced by the operational systems. You don't want to recreate the wheel for your KRIs. from your actual operational systems. Provide early warning for risks that are increasing. You need a method for aggregating and escalating material changes. And it should be the basis for your tactical and strategic decisions. Okay. KRIs should also be vetted by your subject matter experts, your SMEs. I think this is really important. Sometimes risk management departments, they make the system, they make the KRIs, and then they just go live and show it to your front office, for example. I think it's very important that your front office and your SMEs are involved right at the beginning and are a partner in creating the KRIs. You want the KRIs to be automatic, as the presentation, I think, showed just before, is you want your data to feed right into your reporting, into your dashboard, and then that makes it most useful. Organizations should backtest and validate their trigger levels and thresholds based upon, back to your risk appetite statement. They need to be, of course, tracked regularly. And then this is probably the advanced part of it, is you should look for correlations and then relationships between your indicators. So we talked about KRIs. Now I'm going to talk about the key performance indicators, which are different than, of course, KRIs. The KPIs measure performance. And, of course, firm performance can be negatively impacted by your KRIs. The business can react to changes in the KRIs and then avoid deterioration in their KPIs. KCIs, key control indicators, measure your firm's control effectiveness. Now, ideally, your technology systems should basically have a single interface that integrates your KRIs, your KPIs, and your KCIs in order to have the clearest picture for the firm. So all of this comes down to data and technology. So let's talk about data for a second. A major requirement is that you have reliable and robust data. There's no getting around that. Ideally, and we're going to talk about CECL in a moment, that requires detailed transaction data and market data. It's very important that at the very beginning, you identify what data is necessary, because going back and adding something later is actually pretty costly. You, of course, want to digitize your data. And then I just have that thing at the bottom, which is true, is duplication leads to inconsistencies, which lead to errors. So it's really important that you spend a fair amount of time right at the beginning analyzing your data. Why is this not good? There we go. Okay. The first example I'm going to go over is, some of you may have heard of this, the current expected credit loss. This came about, it's actually been sort of in the works for around eight years or so. After the 2008 financial crisis, the IASB, which is the International Accounting Standards Board, and the FASB, which is FASB, they started working together on the development of a new standard to switch from incurred loss over to more of a early warning system, and they definitely saw the need, and I'm going to show you some graphs which illustrate why this was needed. And here's a quote from Deloitte, which I think is sort of sums up things very well. IFRS 9, and IFRS 9 is the European version of CECL. It actually went live, I believe, in 2014. So they've had it live since then, and the US CECL is going to go live at the end of 2019. But IFRS 9 and CECL represent the biggest change in accounting standards since the standards were established. all of an organization's functional areas, business, risk, accounting, modeling, and others, should be aligned and work collaboratively to develop and implement new loss estimation models. So we'll go over what they mean by that, but I think if Deloitte's saying that it's a big change, then it's a big change. Okay, so first let's go over what does CECL apply to? It applies to your held for investment loans and receivables, and on the security side, it applies to your held to maturity securities. As you can see, it doesn't apply to your mark-to-market securities because those are mark-to-market by definition. Excuse me, those are mark-to-market every day anyway. So these are securities which traditionally were held on your books, and you only had to have evidence of credit deterioration before, which led to some problems. Now you're actually estimating using your models all the way to the life of the instrument. Okay. I'm just going to go over a few definitions, just so we're all kind of on the same page. First of all, it's principles-based. The new rule is principle-based, so they're not going to tell you exactly, FASB isn't going to tell you exactly how to do it. Allowance for credit losses. This just is the allowance that requires an estimate of your lifetime expected credit loss for what we went over, your held for investment loans and your held to maturity securities. Went over what CECL was already. Available for sale securities. You have to recognize an allowance for credit loss. There's a zero loss exception for certain debt securities, such as U.S. Treasuries. I don't think I really need to go over the others that much, but just to say that I think the last one is important, is the credit loss models, because they differ for many different financial institutions. I think it's important to understand that it's going to be the implementation of CECL at one bank may be very different than another bank because every bank has their own credit models. Okay, so now I'm going to go over a graph which sort of illustrates why the IASB and FASB is doing this, basically. As you can see on the graph, that obviously the blue in the middle is the financial crisis of 2008. Okay, so going into the financial crisis, the bank's reserves were too low, and you can basically see that as the blue line. And then you can see that they spiked up. Right, actually, I'm sorry, it's the black dash line. The black dash line spiked up, but it really started spiking after most of the crisis was already over, basically in the third quarter of 2009. So the current rule is called ALLL, or some people just call it all. And this allowance for loan and lease losses, this basically specifies that you have to have clear evidence that the credit instrument is deteriorated, and then you take your provision. And the problem is that it's too little, too late, it's pro-cyclical, and it's not providing any early warning for the bank and for any regulator which is monitoring the bank. And this has actually been the rule for the past 40 years in the United States. And it uses what's called the incurred loss standard. Okay. So now what I'm going to do is compare the rule that's in place right now, the incurred loss standard, with CECL to sort of show you the difference. between the two. Okay, so first let's look at the green line. This is the home price index, and you can see this graph goes from 2004 until 2012. So you can see that it peaked in 2006 and declined quickly during 2008. Okay. Now you can see the red dashed line. That's the incurred loss standard. That's the current FASB rule that we have right now. And you can sort of see that it increases as the delinquency rises, but it even has a lag effect from the delinquencies. So as the home prices started to weaken in 2006, the ALLL did not smoothly increase, but it very violently went up starting in, call it late 2008 or mid 2008, and then peaked. So it was definitely a lagging indicator. The peak, just so it might be a little bit hard to tell from the graph, but the peak of the ALLL was actually 15 months after the start of the recession. Now we'll talk about the CECL line. That's the blue line, so the blue dashed line. So the blue dashed line is using credit models to form an estimate right from the beginning of the instrument coming onto the balance sheet. So you can see that it starts to smoothly increase in the beginning of 2006, and then it peaks in 2008, which is good. That's sort of when the financial crisis was going on. So the bottom line is that CECL is giving you an early warning. I mean, it obviously isn't telling you that it's going to happen in the future. It's not obviously that good, but it is giving you at least some early warning that something's happening in the economy, in the housing, whatever is affecting your credit instruments. It's giving some early warning to that. And I did want to bring up one thing to keep in mind, is that it's not all perfect news, because the one advantage that ALLL has is that there's no real models involved, so it's pure credit risk. So even though it's lagging, it's very pure in that it only moves with credit quality deteriorating. The thing to understand about CECL is that it's got many factors. It's got credit, it's got your model assumptions, it has your economic assumptions. So you can have a movement in CECL without the credit actually moving. And that's because your economic factors will move, your model factors might move. The point that I want to make is that because CECL is more complicated, it's multi-factor, and it's got probably several models involved. One has to understand that it can move, and it's not pure credit risk like ALLL, but ALLL is definitely inferior because it's too much of a lagging indicator. Okay. Let's see. Okay. Just make sure. Yep. So here, this is the key measurement considerations of CECL. I'm not going to go over every one of these, but I'm just going to highlight some of the points here. The most important point, probably, of CECL is that expected credit losses are recognized early in the credit cycle, not after the credit cycle. That's probably the number one change here. Second, different firms will have different models, different economic metrics, different forecasts. And so it's going to be hard to compare between different firms. We mentioned lifetime losses recognized at origination. One of the recommendations from FASB is that you need to have supportable forecasts. So it's important that your economic scenarios, they now need to go out to the end date of whatever is the firm's longest maturing credit instrument covered by CECL. And this could be a really daunting task for some firms. So if you think about it, if a firm has a 30-year mortgage, you're gonna have to have economic forecasts for 30 years. If they've got a 50-year instrument, held to maturity instrument, they're gonna have to have 50 years of an economic forecast. So that's gonna be daunting and hard. The other thing that's very, very important on the bottom right-hand corner is that everything has to be documented and stored in a secure manner because you are dealing with a FASB rule, and I'm sure there will be audits on this. Okay, so what's the good news? The good news is that most firms already have robust stress testing process in place. And hopefully, they should be able to leverage the stress testing process that they already have in place for CECL. Obviously, it depends upon the models that the firm uses in their ALM, in their credit areas. They will need to go to the transaction level. Some firms don't do this. So it all depends on how the firm was set up. But of course, every firm would need to evaluate their models and their processes. What's the not so good news? The not so good news is probably mostly for the regulators, although I think it's kind of a mixed bag for the regulators. I think the regulators will like the fact that that firms are consciously looking at the credit risk right from the beginning of putting on these credit instruments. They'll definitely like that. What they won't like is that it'll be virtually impossible to compare the CECL numbers from firm to firm. And that's because of what I mentioned before, that the credit numbers are the credit numbers. Okay, so that's straightforward. But the economic forecasts are going to be different for every single firm. The way they do the economic forecasts are going to be different for every firm. And the models will most probably, unless they're maybe buying a model from a third party, but if a firm is making their own model, which a lot of firms do, you would not be able to compare, even for the same, let's say two firms were holding the same exact credit instrument, they would most probably under CECL have different numbers, and that's because the modeling and the economic forecasts will be different between those two firms. Okay. This is just another example of that the building blocks of stress testing and CECL are pretty much the same. They may have to be used differently, but at least they are coming from the same general area: data, analytical capabilities, your models, and your reporting. So under valuation, a firm's going to have to be able, though, to value all their credit securities and go out to maturity using economic forecasts and then discount that back to a number today. Forecasting capabilities, they're going to have to evaluate their transactions on a daily basis, incorporate their economic numbers, and then they're going to have to save all of their assumptions, all of their data every time that they run this. And that might be a little different for firms that are maybe used to running stress tests on a quarterly or annual basis. So that'll definitely be a change. Cash flow generation, they will have to generate all their cash flows for the lifetime of the credit instrument and then flow that into their credit models. Okay. Sorry. Let's keep this up. Okay, I think CECL is a good case study also I had mentioned data before, and I think it's a good case study to look at the data that's necessary for CECL. Like I mentioned, this should definitely be studied very carefully at the very beginning, so you don't build it and then have to go back and realize that you missed something from the data. The data that, of course, is going to have to be included, everything about that instrument you're going to have to get access to, all the dimensions that your models need, all the dimensions for pooling and aggregating it in reporting, your historical loss information, and then you're also going to need your macroeconomic data, your historical, your current, like I mentioned about those forecasts. The way the FASB rule works is that you have to go from the inception of the credit instrument all the way to the maturity date of it. And so that's going to be interesting to try and do a forecast for that period. So the point of this slide is that even after you've got the methodology and the models created and you've tested them, the CECL process will still have, the people who are in charge of that will still have a lot to do, because I'm sure there'll be senior management and regulators are going to question, why did you make those assumptions? How did you come up with that economic forecast? How will it affect your balance sheet? How will it affect your business? So this is just to illustrate that once you get it all set up, there's still going to be a lot of explanations that are going to have to be made. And I think it's very important, as I mentioned about documentation, I think it's really important that everything is documented, because you are dealing with forecasts and assumptions and model assumptions. All that has to be defended in the future. Okay. As I mentioned, FASB has not prescribed the exact methodology for CECL. So they're leaving it up to each firm to come up with what they feel is the best way of doing this. Now, there's been white papers written of how best to approach this, using regression, migration, different valuation techniques to be used for this. The main point is that, as you can see there, what I put in bold and underlined is that we're talking about a lifetime probability of default. And, for some firms, this will definitely be a big shift for them, that they have to move from, for these types of instruments that they used to just put on their balance sheet, held to maturity, and only if the company started getting into trouble did they need to start taking any action. Now there'll have to be a constant monitoring, getting all the data for the models. You have to put that allowance for credit loss from CECL right from the first day of putting these instruments on the balance sheets. So that's going to be a big shift for some firms. And then the expected impact of CECL. There's no number yet that the like the Big Four have come up with, but they do believe that there's obviously going to be an increase in the ACL, and that the other shift is probably going to be that investments in improved capabilities will have to take place. And you also have clearer information about your credit instruments, which could have an impact on which instruments firms decide to leave on their balance sheet. So in other words, if you had a credit instrument that went out 100 years, let's say, and there are a few out there, that starts to become quite a task for their economics department to try to put in a defendable forecast for 100 years, I would think. Here, I think this is like one of the really important points of my talk, is that once you do this, you should have a feedback loop back to the business pricing. So a lot of what I talked about is FASB and regulations, and I know a lot of front office people, they're not very happy about that because it means expense. But here's something that is interesting, is that if you do this, since you have to do this anyway, because it's FASB, is you can actually use this to provide a feedback loop back to your front office pricing, because you're now modeling your credit instrument maybe better than you have before. It also should allow upper management to know the sensitivity of all those credit instruments that before were sort of just put on the balance sheet. Now they actually have a dynamic indicator of how they're doing. Okay. The second example I'm going to give, but it's going to be more cursory view of it, is liquidity risk management. And the main point here is that good liquidity risk management also requires good data and good systems. The second and third lines of defense should bring that up, that better data allows you to keep a smaller buffer and earn more from your core and excess liquidity and comply with regulations. So that's why I have the scale here, is that I know that when a lot of second and third line ask for budget for systems, the people who control budget say, well, what are we going to get out of this? How is this going to impact positively the profitability of our firm? And my point here is that by having better systems and by having better data, you can actually invest your core liquidity and your excess liquidity better, which actually will directly impact the bottom line of the firm. So the same is also true for funds transfer pricing. This is sort of a close cousin to liquidity risk management. This is how the Treasury prices out both receiving liquidity and giving of liquidity to all the various parts of the firm. And the more accurate the Treasury can do this, then the better the firm can run. It's also very important that Treasury provides the right incentives to the front office. In fact, I was having a discussion with a senior Fed official, and he told me that their view was that one of the major causes of the financial crisis was that the funds transfer pricing at most firms wasn't taking into account contingent risk well enough, and therefore there were wrong incentives at a lot of firms. So, in conclusion, hopefully I've showed that good systems and good data for risk management can be justified. One, it creates a feedback loop for better management and better pricing. The planning of your KRIs and your KPIs and your KCIs are critical to success of your ERM area. It allows a view on the risks, performance, and controls of the firm. It should allow an improvement in profitability. Your pricing of your HFI loans and your held-to-maturity securities can now take into account the current expected credit losses during the entire lifetime of the transaction. It addresses the opportunity cost of leaving a large liquidity buffer and investing that in cash or very short-term instruments like T-bills. And of course, most, importantly, it allows you to meet your regulatory guidelines. Thank you very much. Any questions? Okay. So I'll tell you what I know about it. After the financial crisis, so we're talking around 2009, 2010, the IASB and FASB got together and had a whole series of meetings. And what they were planning on doing was issuing the same type of rule for both of them simultaneously. And they met through the years. And from what I understand, they couldn't agree on exactly the same set of rules, basically. And so there was a split, and in 2014, IFRS 9 went live for Europe. But it has, the general gist of it is the same as CECL. In other words, using credit models to, over the lifetime of the instrument, what's your allowance for credit loss, and then discounting that back at the appropriate discount rate. So the two have exactly that in common. Now, I'm not an accountant, so there are some subtle differences between them. I couldn't go over those, but the general gist of it is the same. But IFRS 9 went live in 2014. CECL will be going live for any publicly traded corporation. It'll be going live December of 2019, and then for other firms in December of 2020. So does that answer your question? Or, okay. Any other? Hard to see. Nope. Okay. Okay. Well, thank you very much.